We are Robert Hall & Associates, the tax consulting firm. Some of you may know me. I go around the LA area and I do short speeches about taxes and incorporating and how to utilize structures to save tax at different caravans, different real estate agencies. So if you have seen me before, you know who I am. If you haven't seen me before, my name is Tony Watson. Robert Hall & Associates is a full-service tax consulting firm. We've been based out of Glendale since 1971. So if you're ever in the Glendale area, right off Glen Oaks Boulevard, between Pacific and Central, stop by, say hi. It's a 3-story building. You can't miss us. In fact, I think the first slide is a picture of our building. So if you want to take a picture of it, come say hi anytime you're in the Glendale area, please do so. Today I have about 20 minutes to talk to you about the top tax secrets, what every real estate professional should know. I know it says realtor up there, but I consider you all to be real estate professionals. And I don't know if you all knew this, but on your tax return, your income tax returns, there's a special election that you make with the government to tell the IRS that you are a real estate professional. Just putting the occupation as realtor or real estate professional isn't all you have to do. You actually have to check a box on your return telling the government that you are a professional working within the real estate industry. Hopefully, you are all making that election, or your accountant is making that election for you. That opens up basically the floodgates on all of the great tax write-offs that you as professional real estate realtors get to take on your individual tax returns. So a little bit about me. You can check me out online, roberthalltaxes.com. I've been working in the industry for 11 years. Lucky me, I got to work through this last recession. It taught me a lot about a lot of my own investments. I am, in fact, a real estate investor as well. So I know a little bit about real estate, but I know even more about taxes and how real estate can help me save tax and pay less to the federal government. Picture of our staff. Like I said, we've been around since 1971. Picture in the background of this is actually our building in Glendale. Won a couple awards in the Glendale area over the past 5 years. In fact, my brother Mike Watson at the top won Glendale's Best Tax Preparer again this year. We just found that out yesterday. I bet you didn't know that there was an award for Best Preparer, right? That's pretty silly. But anyway, we've won a couple awards over the past couple years, so you can check us out online. Probably the #1 question asked in my office from a real estate professional is, should I buy or should I lease a car? How many people have thought to themselves whether or not buying versus leasing is something they should ask their tax preparer? Okay. I know there should be more hands, so if you don't want to participate, that's fine. I know it's early, and it's way too early to talk about taxes, but I'm here. So take some notes if you want. Obviously, this is something that you can take a picture of. There aren't very many notes on the PowerPoint, but if you need to pick up the phone and call our office and speak to me for some clarification as to some questions that you may have, please do so. Our phone number at the very end will be posted on the PowerPoint, so you can give me a call anytime. Buying versus leasing is a really important thing to think about because obviously some of us are more purchase prone than lease prone because we'd rather own our own assets, right? Well, not only do you have to think about owning your own asset in this particular instance, but you have to think what is going to give me the largest return on investment when it comes to taxes. If you are a high income earner in the 25, 28, 33, 35, 39.6% brackets, remember that every dollar you take as a write-off on your return is going to save you whatever that percent is in tax. So if I spend $1 and I'm in the 28% bracket, that dollar saves me 28 cents, right? That makes sense. So if I go out and I purchase a vehicle in a higher income bracket, let's say I'm buying a $40,000 vehicle, in the first year of ownership, the government says that if you purchase that vehicle under a business or personally, you don't have to be incorporated to do this, if you purchase that car, you get an upfront write-off of $11,160. This is if the car is under 6,000 pounds. Now, why is that number important? Because as soon as the vehicle weighs more than 6,000 pounds, the government gives you an upfront $25,000 write-off, and then included in 2017's tax code and 2016's tax code, if you haven't filed for 2016 yet, coming up the deadline in what, 4 days, 5 days, you get a 50% bonus depreciation write-off. Now, what the heck does that mean, Tony? If I buy a $40,000 vehicle, my write-off doesn't start at $20,000, or it doesn't start at $25,000. Well, actually, no, $40,000 would be $20,000. Let's say I buy a $60,000 vehicle. I don't only get the $25,000 write-off, I get the accelerated bonus depreciation of an additional $5,000. So I get 50% of my $60,000 vehicle purchase as a write-off. That's a $30,000 upfront write-off that I get all in 1 year. That's if I purchase the vehicle. Now you can imagine that if you're in a very high income bracket, let's say the 39.6% federal bracket, that's 40%, pretty much round up, and then the state income brackets of 9.3%, to add those two together, that's around 50%, right? So if I go on and I buy a $60,000 vehicle and I get a $30,000 write-off for it because it's over 6,000 pounds, that $30,000 is going to save me roughly about $15,000 in tax. So kind of coming full circle, $60,000 purchase saves you $15,000 in tax. That's a pretty good return on investment, correct? Now cars are depreciating assets. So I'm not saying to go out and buy a vehicle just for the tax write-off. This is if you are looking to upgrade or renew maybe a lease instead of leasing. Because of the high income this year, you opt to buy. It could potentially give you a pretty sizable savings when it comes to filing taxes. All right. Leasing is a great option as well. However, you have to look at a couple things when going to lease a car. You have to look at how many miles you put on your vehicle. And let's face it, real estate professionals, you put a lot of miles on your car, right? So if you put over 15,000 miles on a lease, normally you are penalized for going over your allowable mileage, right? And that penalty is not tax deductible. That's important to remember. Because you're thinking, well, I'll go over, but I'll just write off the penalty. Unfortunately, the penalty is not tax deductible. Your lease payment may be, but if it's your only vehicle, you have to allocate how much of the time you use it for personal use and how much you use it for business use. So when you think, oh, the lease is 100% tax deductible, it may not be. Unless 100% of the lease is written to the business that you own. And at that point, if you have a corporation, the corporation has to be on title, it has to be on the lease agreement, you have to jump through all these hoops, and at the end of the day, you're probably going to pay a little bit more insurance because it's a corporate lease and not a personal lease. So as you can see, it's kind of a complicated answer, right? Is purchasing versus leasing better for you? It really all comes down to your personal scenario. What tax rate do you normally file in? If you are a high income earner making the 28, 25, or 25, 28, 33, 35, 39.6% amounts, you're probably going to opt to purchase a vehicle because it gives you a larger upfront tax savings. If you are consistently filing at the 15, 20, 25% brackets, you're probably going to want to lease because it's a more consistent write-off for you. It's going to save you a more consistent amount of tax on a year-to-year basis. Me personally, if you stopped me on the street and said, I don't know that you're a tax preparer, but I'm going to ask you a personal question, would you rather buy or lease a car? Me personally, I never rent, I never lease anything, because I want to own whatever I'm paying for at the end of the day. So when you ask me personally, I think purchasing is always the best option. That's because at the end of the day, I own the vehicle. But when I put my tax preparer hat on, I have to look at two scenarios. I have to look at, one, how much tax you normally pay, how much return on the investment are you going to have, and also, do you want a new car every 2 years? That's really the benefit of leasing a vehicle, is that every 2 years you get to go and trade it in and get a brand new vehicle, right? And they also cover all the maintenance and the repairs, things like that. So those are also things that you have to take into account. These are very important questions for you to ask your tax preparer. Do not let your tax preparer shove you out the door after they're done preparing the return without answering these questions for you. Because at the end of the day, it could be a matter of saving a couple thousand in tax, possibly even $15,000, $20,000 in tax, depending on the purchase price of the vehicle. So the key number for you is, hey, am I going to buy an SUV that's over 6,000 pounds, or is my vehicle under 6,000 pounds? How much is it going to save me at the end of the year? Have this conversation with your tax preparer. Now let's talk about audit for a second. Obviously, this is a scary word that's tossed around within multiple industries across the board. As a tax preparer, me personally, I have to tell you, I'm not very afraid of my own tax return being audited because I work every day in this industry, right? I know what the government's going to look for. I know what the answers should be in an audit questionnaire. I know how to respond with the IRS. So to me, I'm not very afraid of being audited. However, the general population is. I mean, back in the 1950s, 1960s, if you were audited, the government could come to your place of business, which if you worked from home was your home, and they could shut your business down. They could deadbolt the doors, put liens and levies against your property, garnish wages. They were a scary entity to deal with. Now, fast forward to 2017, we have representation by a nonprofit organization called the Taxpayers Advocate. How many people have heard of the Taxpayers Advocate before? It is a nonprofit organization not owned by the federal government that actually will fight the IRS if the IRS is being unjust with the assessments that they're giving you. Basically, if they're being unfair. All right? So we have rights nowadays as taxpayers. I know it might not feel that way, but we do. So the most important thing for you to do before anything, if you get anything in the mail from the IRS, first off, you need to package it up and send it to your tax preparer ASAP. If you are ever audited, do not try to go into the audit and represent yourself. Even if you think you know the tax code, I highly suggest that you pay for representation, especially if your return is a complicated return, meaning you have rental properties, self-employed businesses, and as real estate professionals, you all file a Form Schedule C. That is a business form on your individual return. The IRS would love to only deal with the taxpayer and not have to deal with me. All right? Because we have 1,000 hours of education in tax code every single year that we have to update our license with. And so pay for great representation. However, if you do get something in the mail that says, hey, we are questioning your mileage, or we're questioning your meals and entertainment, we're questioning something on your return, what do you think is the first thing that they would look at on your return? Do you think it may be the in-home office? This looks like a pretty nice office, right? As you can see, there's no treadmill, there's no elliptical machine, there's no baby crib, there's no dog toys or cat toys. This is 100% used for business. This is an in-home office. And the government, this in fact, when I told you that in the 1950s, 1960s, the IRS could come and deadbolt doors to businesses, this is the one write-off that the IRS can still come to your house to verify. And they will come to measure the square footage in your home used for business. They'll make sure that there's no treadmill, there's no elliptical, there's no baby crib. Because at the end of the day, an office is a seat for your client, or if you're a therapist, there's probably a little couch that your clients can lay on. There's a seat for you to sit in. There's a computer. There's some wall art and some books and whatnot. At the end of the day, this is a legitimate in-home office. The in-home office form alone runs close to a 75% chance for audit on a year-to-year basis. It is one of the highest audited write-offs on an individual return. However, you should not look at the increased potential for audit as a bad thing. You should look and to not take the write-off. You are allowed this. This is an ordinary, necessary, and legitimate write-off. And above and beyond anything, if you use the right square footage, it is a reasonable write-off. So those are the three things that the IRS looks for in every single write-off, for the deduction to be ordinary, necessary, and legitimate. But above and beyond anything, make sure that you are being reasonable. When you have a 1,000 square foot home, saying that 500 square feet is for in-home office use, that's a little bit unreasonable, right? Even if it may be true. That's the crazy thing. Even if it's true. And if it is true, put the 500 square feet down and take 50% of your home as a write-off. Just understand that that runs a pretty high risk for being questioned. 75% chance for being audited every year, not the number one most audited part of your return, though. What about charity? Charity runs a pretty high risk for audit, right? The money that you give to nonprofit organizations, to your alma mater, the charitable mileage, volunteer hours, the non-cash contributions you give to Goodwill, Salvation Army out of the closet, right? Those are great tax write-offs. In fact, those are probably the number one write-offs that the wealthy, the 1%ers of the world take. Because under the current tax administration, and remember, 2018 will probably be under a completely new code, going from 7 brackets to 3 brackets. But under the current tax administration, charity is one of the only 3 write-offs that the 1%ers are allowed to take on their individual return. I don't know if you all knew that. There's something called alternative minimum tax. Just by show of hands, how many people have heard of AMT? I feel sorry for you if you know what AMT. Well, actually, I don't, because that means you're making good money. But once you breach a certain AGI, a certain adjusted gross income, that's at about 175. It actually can start at about 138. But once you breach 175 in adjusted gross income, you are subject to something called alternative minimum tax. The best way I can describe AMT is it's like a cap. It's like a ceiling. And as your income grows, you're continuing to write off more and more expenses. And then once your income breaches that AGI of 175, the government puts a cap on the amount of non-reimbursed business expenses that you can take. Non-reimbursed business expenses are things like cell phone and travel and meals and entertainment. So they cap it. It is a flat tax for the wealthy. And so the only 3 write-offs that those 1%ers are allowed to take now, it's kind of silly to think 175 is a 1%er, but that's where the government starts it at. 3 things: property taxes, mortgage interest, and charitable contributions. That's why the wealthy of the world, they build hospitals. And they donate millions of dollars to schools, because they can actually donate up to 50% of their income, fully deducting that 50% of their income as a dollar-for-dollar write-off. Pretty crazy, right? And at the end of the day, they've got their name on the side of a hospital building. It makes them look good, and they pay very little tax because of that contribution. Charity runs close to a 60 to 65% chance for audit on a year-to-year basis. It is proven with backup documentation, though. I mean, if you donate $100 million, you're going to have a transaction receipt for it, right? If you donate $1,000 to your church, you're going to have a receipt for it. If you put cash in the basket as it's going around on Sunday morning, that's probably not going to stand in an audit unless it is a reasonable amount. If you say that you donated $15,000 of cash, $100 bills to your church, get a receipt for it. If you donate $300, $400, I'm not so worried about that. The government will let that fly because it's a small amount. For every drop-off that you make to Goodwill, Salvation Army, out of the closet, make sure that you get a receipt for the drop-off, because for every single receipt that you get from Goodwill or Salvation Army, you can take up to $499 as a deduction. It has to be under $500 per receipt. Here's the crazy thing about that kind of charity, the non-cash contributions. If you donate goods that are over $500 and you only get one receipt, you actually have to take pictures of all of the things that you donated, and you have to pay to have all of those items appraised. And then you have to paper file your return and attach the appraisal to the tax return. So the best thing that you can do is get a receipt for every incremental $500 that you donate. So if you donate $2,000, get 4 receipts. Does that make sense? And that way the government will allow you $500 per drop-off, essentially. Not the number one most audited part of your return, though. Why are you playing with us, Tony? What's the number one most audited part? Charity runs a 60 to 65% chance for audit, but you normally prove it with backup information that you give to your preparer, and we keep it on record. The number one most audited part of your return actually is not a deduction at all. It is the reporting of your gross income. Crazy, right? The first thing that an auditor asks for in an audit are 12 months of bank statements, so that they can go through and add up all of your deposits. And they want to make sure that 100% of your deposits are being reported on your return. And you're thinking, well, I deposit things into my account that aren't income to me. Well, and at that point, if it doesn't match up with what's on your business return, they're going to want to know what they should be taking out. And at that point, you have to prove to the government that this personal loan from a family member of $20,000, that's not income to you. So you have to prove that to the government. Which leads me to a very, very important part of why I'm here today. As self-employed business owners, remember you are all business owners, as self-employed business owners, real estate professionals, for your self-employed business, you need to have a completely separate account where you receive all of your commission income and where you spend all of your money out of. Does that make sense? Because if you deposit your spouse's W-2 income into the same account that you deposit your commission income into, and then you and your spouse are spending all of the money out of that same account, what is that called when you mix and mingle personal and business income and expenses? Commingling. And the government will have a field day with that. All right? So make sure, do yourself a favor, cut it off at the pass, separate your business income and your business expenses from everything else that you own personally. I run into this with a lot of property owners. When an individual owns 10, 15 rental properties, they have one bank account where all of the rent is deposited, and then all of the mortgage payments are made out of the same account, and the property tax are paid, so on and so forth. Remember that in an audit, the government's going to want to see a breakdown per property. Now, I'm not saying that you need to have a bank account per property. That is actually the truest way to organize your information, but it sounds kind of hectic to have 15 bank accounts, right? So you can have one bank account. Just make sure that you have bookkeeping done per property. Because at the end of the day, let's say that property 14 needs a new kitchen improvement. The government doesn't want you using that kitchen improvement to offset property 1's income that has no debt, that's already improved, and cash flowing like crazy. They want you to separate out those income and those expense amounts, okay? So if you have any questions, hang on to those. I'm going to stick around after this to answer any questions, okay? And it's unfortunately, it's too large of a group. Well, fortunately for me, but unfortunately for you, it's too large of a group to answer questions. So gross income is the number one most audited part of your return, all right? I'm going to be wrapping up here soon, okay? Just wanted to touch on this as well. Moving into 2018, a lot of people have heard speculation about what the new tax code is going to be. And yes, it is true, we might be going from 7 brackets to 3 brackets. But that's not only the major change that you should be focusing on. You should be focusing on the benefits of having an incorporated entity as well. Under the new tax code, the corporate tax rate is potentially dropping from 35% to 15%. Now, some people have said 20%, some people have said that's not going to pass. At the end of the day, that probably will actually pass under the new tax code. That means that all of your profit through an incorporated entity such as an S corporation, instead of paying a variable tax rate at 25, 28, 33, 35%, it's going to be cut flat at 15%. It could potentially save you thousands. We're not talking about the thousands of dollars in savings for purchasing a car anymore. We're talking about on top of that, saving you an additional $10, $15, $20, $30,000 if you were a high income earner. So have the conversation with your preparer as to what the differences are between the insurance policy, the incorporated entity, and the trust. Because all three of these things provide a completely separate benefit. Number one most important thing to have is insurance. The incorporated entity does not pay out settlements, but it does separate business and personal assets. Above and beyond that, as you build your wealth, you're going to want to set up a trust to protect all of your assets from the state of California, so that they are protected for your heirs. All right. So come see me up at the front, at the tail end. If you have any questions, I have some information that I can give you as to how to contact me. Like I said, if you're ever in the Glendale area, come by our office, say hi. A lot of people at the end of my seminars kind of feel like this, and I only had a short period of time to talk about something that's very complicated and confusing a lot of times. Check us out online. We've got great reviews. More importantly, oh, that's a picture of our building. More importantly, we offer free 30-minute in-person or over-the-phone consultations. Like I said, if you've heard me speak before, you've probably heard the 30-minute free consultation that we offer. Take advantage of it. Whether or not for you, if it's for your kids, if it's for your parents, your clients, people get confused when you start talking about taxes. And it doesn't have to be confusing for them, especially if there's free advice out there for them to get. All right? Thank you so much for having me.
Thank you.